Hi guys, Martin from TTC here, and this is a quick canter through the CAA's hotly anticipated ATOL consultation, which landed a few weeks ago. Now, I say hotly anticipated, it's fair to say I've not been getting out of the house much recently. But the consultation sets out proposals from the CAA for future funding arrangements of the ATOL scheme and for some new rules around protection of customer money. The CAA set some fairly lofty targets. They're looking to introduce a more systematic approach to ATOL holder risk. They're looking to encourage and incentivize ATOL holders to reduce their reliance on customer money and to put the long-term funding of the scheme on a more robust footing. At the outset, I think it's important to say this is a consultation. The CAA are seeking views and information on what they've set out, and they do insist that they haven't made their mind up yet. So I think it's really important that everybody has a read of the document and does make sure they have their say. So the consultation broadly covers four areas. It looks at the reliance of customer monies, reliance that travel companies place on customer monies. It looks at risk-based pricing of the ATOL protection contribution. And then it looks at a couple of more minor changes, one respective agency agreements and the mechanism for renewing agency agreements, and another on the way small business ATOL holders pay their APC. So we'll focus on the first two in orange there. We won't talk about the other two in too much more detail. The document, the consultation document, makes several broad assertions at the outset that, firstly, the travel companies are generally thinly capitalised and over-reliant on customer money. The CAA are asserting that the companies who did segregate customer money already have generally fared better in looking after customers during the pandemic. And they also talk about how the flat £2.50 per passenger APC, which is in place at the moment, underprices the risk on some travel companies. I think, though, it's important to remember really what the key driver of this whole consultation is. Really, it's the Air Travel Trust Fund and the current state of the fund. Air Travel Trust Fund is the pot that holds all of the £2.50 APC contributions, and that's the fund that's used to refund and repatriate customers when an ATOL holder fails. Fortunately, this is the Air Travel Trust Fund right now. The cupboards are bare after the Thomas Cook failure at the back end of 2019, together with the pandemic, almost a whole year now of reduced APC income. The fund would typically take in 50 to 60 million pounds of APC income every year, and you could easily see that that's been decimated just from reduced bookings. So the problem now is that the fund is effectively wiped out to zero or below zero. There is an overdraft facility of 75 million pounds in place, and there's a government guarantee that sits behind that. But of course, once we're into negative territory, this is no longer a travel industry self-funded pot of money and a travel industry self-funded scheme. It's now taxpayers' money that is at stake. So there's definitely pressure on the CAA from government and from Treasury to tighten up the scheme. And I think really that's what's providing the impetus and driving the changes. So the CAA lay out a series of options, almost a menu of different choices. Some of them are interdependent, some of them are an either or type thing, but we'll just run through those now. So option A is that the CAA set out a single mandatory framework that everybody has to comply with. And they broadly lay out two different options for that. They firstly say either that they could insist everybody segregates client money, and they propose three methods of doing that, either a client account, an escrow account, or a trust account. Not going into too much detail on those just now, but think of them as effectively a sliding scale of increasingly more onerous ways of separating customer money, but the impact is still the same. It's taking customer money, putting them into a different bank account away from the rest of the travel business's own cash. And the CAA talk about how they may look at either insisting on 100% of monies being segregated until the customer returns, or whether it should be some portion of the customer monies that's collected. So that would be the first part, is insist on everybody does that. Second option would be to reintroduce mandatory bonds for everybody. This would effectively be reverting back to the scheme we had pre-2008, before the introduction of APC and the passenger levy. A couple of things on that. Firstly, clearly insurance markets are very challenging at the moment, and it would seem like quite a big ask to try to recreate that. So that does feel like it would be something that would take time to reproduce. And the second thing is the CAA does note that this sort of option would fail to drive some of the behaviours they want to achieve, this idea of travel companies being much more responsible for the way they look after customer money. So that's option A, is a mandatory system that everybody has to comply with. Option B is more of a tailored framework. So the CAA would decide that travel companies must protect some portion of customer monies. And in the example they gave, they talk about, say, 80% of money as a mandatory minimum needing to be protected. But then they would allow travel companies to have some sort of choice over how they could go about protecting that money. So, for example, you could choose to protect all of the 80% by segregating monies, or you could protect it all by using bonds, or you could use some sort of blend. And travel companies would be able to look at that and put some sort of combination in place that would suit their particular risk profile or business model. What's important to note is with this option, this would go hand in hand with this idea of risk-based APC pricing. So basic assertion is that the current £2.50 flat rate isn't reflective of the risk. CAA proposed two ways of correcting the £2.50 effectively being insufficient. One is to just simply maintain a flat price for everybody, but increase it. So everybody may pay, say, £5 or £10 as an example. But the other is to introduce something along the lines of risk-based pricing. And again, the CAA proposed three ways they may look at that. One would be some sort of variable risk-based based on the business risk or the business model risk. So that would include things like the capital structure of the business. It would look at, say, how the business treats customer money and what sort of reliance they have on customer money. So that would be one option, would be to look at it on a sort of risk-based approach. Second way would be to simply look at the average price of the holiday. You can make a case for much more expensive holidays. When companies fail and the holidays are more expensive, there is more of a cost on the CAA. So that might be one way they would look at it. And then the third is some sort of hybrid between those two, where there would be some mechanism to look at both the price of the holiday and the underlying risk of the particular business model. So that's option C, and option C would go hand in hand with option B. So companies, for example, that were taking a lower risk approach of, say, segregating 100% of customer money would expect to pay a much lower rate of APC than a company that was relying entirely on bonding, and therefore the CAA would charge them a higher APC. Not a lot of detail at this stage, but CAA really are looking for just commentary on the various mechanisms they're proposing. The next is option D, what you might call the open market solution. In effect, this is a proposal that the CAA could throw the whole consumer protection regime over to a third-party commercial insurance market and effectively force everybody to go out and get their own insurance. And the theory here, I suppose, is that the insurance market would be more experienced and more able to price risk on a more commercial basis. I suppose there's probably two reasons why I think that this isn't really a viable option and it's unlikely to go much further. Firstly, it doesn't really seem hugely sensible given the parlous state of the insurance market right now and the experiences of the CAA in renewing their own insurance scheme over the last few years. It seems like that would be quite a big risk to pass all of that over to third-party insurers. I think more fundamentally, it would mean the CAA effectively dismantling their own machinery and basically disbanding, certainly significantly reducing their functions. And maybe you could call me cynical, but I just don't really see them doing that. And I think to emphasize the point, we've got a queue here of some actual turkeys lining up at the polling station to cast their vote for Christmas. So that's the CAA document. We'll be working our way through that and we'll be putting together our own formal response, and the closing date is the end of July. I suppose there's probably 5 broad themes that we'll make sure that we include, and I'll just run through those quickly now. The first, I think, very important point that we need to get across is related to transition arrangements. This is absolutely key in my view. Any of the changes that I've proposed and that we've just run through will take a long time for companies to adjust to. And that's before we get into the fact that as an industry, we've been battered by the events of the last 13 or 14 months. So transition needs to be long and gradual. The second point really is to do with airlines. Arguably, it's the actions of the airlines and the speed of refunding from airlines that's caused many of the problems, and the timings or the abilities of people to make refund payments to their customers. That's largely been driven by airlines holding on to funds. So addressing the tour operator and travel agent part of the market is only part of the problem. And to us, it seems entirely sensible to try to look at the whole of the problem. There was actually an airline insolvency review commissioned back in 2017, and it did actually report in 2019 with some fairly concrete proposals for what they saw as more of a risk-based approach to protecting airlines. And these proposals have never got off the ground, and partly that's because lots has happened in the interim. But it feels like these proposals that are being set out in this consultation really place all of the responsibility for covering off that risk at the door of the tour operators and the travel agents, and that doesn't feel equitable. So airlines really need to be considered as part of this whole process, we think. The third point is that really we want to encourage the CAA to broaden this consultation. They've gone out to tour operators and ATOL holders at the moment. But actually, if you look at those various options, as an example, insurance and bonding seems to underpin a huge number of what they're trying to achieve. But to our understanding, they haven't yet gone out back to the bonding market to try to encourage them to understand what it is that they would need to come back into the sector. And so really, for this to be workable, those different stakeholders need to be brought to the table, and the CAA needs to have a strong role to encourage that. I don't think it's good enough to just hope that bonding comes back. And I think you could say the same thing about other important stakeholders like merchant acquirers and supply failure insurers. Both of those groups are pivotal to this whole system working, and they again need to be brought into the thinking. The fourth thing really is that we think the CAA should definitely be prioritising simplicity. The ATOL scheme is already far and away the most complicated financial protection scheme in the entire world. And a lot of these proposals that are set out in this document feel like they would add to that complexity. You know, how exactly does the risk-based pricing APC, how transparent is that? How easy is that to understand? How easy is it that customers would understand any of these changes, and let alone people in the industry trying to cope with them? So simplicity needs to be really clearly thought through. And I think the final thing is just looking after agents. I think the CAA need to be really careful about some of the comments they've made about how they would adjust the travel agent model. The proposals in the consultation, for me, they feel a little bit like afterthoughts. They're sort of footnotes, but actually on examination, they fundamentally change the way travel agents would work. Now, the way I understand it, the CAA is trying to close off one particular risk. This is this issue that came about a couple of years ago, where it became clear that some agents had been collecting and holding way more pipeline money than they should have at the point of a failure. But by forcing all agents to pay tour operators the gross amount of all of the money and only get their commission after the customer has departed, will add a lot of complexity. Not least, it will hurt from a cash flow perspective, and I think could be ruinous for a large proportion of the travel agent community. Ultimately, it feels like it's disproportionate in the way it's trying to address this one particular issue, which clearly is an issue and does need to be addressed, but this doesn't feel like the right way to do it. So that's our view. Really hope you found it useful. The consultation runs till the end of July, so really do encourage everybody to have their say. We're very happy to talk through ideas and help you form your own responses. You can find a link to the CAA consultation document in the comments field below. Thanks for watching.